Welcome to a crash course in tax liens by TaxLienInvestorsSecrets.com. What is a tax lien? The easiest way to understand what a tax lien is to first understand how the county government works with property taxes. Everyone that lives within the county boundaries is forced to pay property taxes. Those property taxes go to provide a number of different services that each one of us rely on a daily basis. So what happens if an individual doesn't pay his or her annual property taxes? Services such as police and fire departments, education, road construction, the county services themselves. Each one of these are all services that are provided for in large part by the property taxes that everyone pays. So if an individual is late paying their property taxes, that actually creates a budget deficit in the services that the county has already agreed to provide. The county needs a way to enforce the property tax system. They need some way to ensure that property taxes will be paid and that they will have the funds that they need to provide all those services that they're constantly providing. The way they do this is by issuing a tax lien against the property itself. Now, they issue a tax lien against the property because it enables them to recoup that lost investment. Here's how a tax lien works. The lien itself is placed against the property. It prevents the property owner from selling it, and it could eventually lead to a loss of property if the delinquent amount is not paid. So it uses that property as security for the delinquent amount. Now, the reason they're able to recoup their investment with this is because tax liens have a set rate of return, which ranges from about 10% on up to about 25%, depending on which state and county you're working in. And they also have what's called a redemption period. The redemption period is the time period in which the property owner has to repay this delinquent amount before that tax lien could actually be used to foreclose on that property. Now, the way that the county recoups their investment is they hold an annual sale. They invite investors from the public to come to this sale and to purchase these tax liens. Tax liens are purchased for the amount of the delinquent taxes plus any penalties or fees that are associated as well. So if you show up as an investor, you're willing to purchase that tax lien because it's going to pay out an 18% annual rate of return, and it has a 2-year redemption period. Now, what that means is that the property owner here, Bob, now has 2 years from the date of the sale before the investor can begin to initiate the foreclosure process. So the county awards this tax lien to the investor as security against his investment. So if we're playing out the scenario, we know that from the date of the sale here that the property owner now has 2 years to pay back that delinquent amount before the investor can actually initiate the foreclosure process because of that tax lien. To remove this lien, the property owner must pay all the delinquent taxes back, including the 18% rate of return that will be going to the investor. So there are penalties and fees that are associated with paying your property taxes late. So let's play out the scenario here of the property owner paying back all the delinquent taxes and fees, which on most properties the value is exactly what's going to happen. No one wants to lose their property due to some delinquent property taxes. So let's say that the property owner pays all of the taxes along with any penalties or fees to remove this lien. Well, in this case, the county will remove the lien from the property and will cut a check to the investor for their initial investment plus the set rate of return that they were guaranteed, which in this case would be an 18% rate of return. Typically, counties will cut these checks within about 5 to 10 business days. So what happens if the property owner doesn't pay back the delinquent taxes within that set redemption period? Well, the tax lien itself, because it's been placed against that property, actually can give the holder of the tax lien the right to foreclose on that property if the property owner doesn't pay that delinquent amount within that set redemption period. So it can actually end up giving the tax lien holder full ownership rights. There are really only two possible outcomes for a tax lien investor or for a tax lien investment. Basically, the property owner is either going to pay the delinquent property taxes back, or he or she is not going to pay the delinquent property taxes back. If the property owner pays the delinquent taxes back, then as an investor, you make an 18% rate of return in this example. If the property owner doesn't pay back the delinquent amount before the redemption period passes, then the investor has the right to initiate the foreclosure process and can actually own that property outright, free and clear of any other encumbrance.